Hi there, welcome to Kneppy Invest. It is about time I did a state of the markets video. I try to do this video once a month, sort of halfway into the month, because at the end of the month or start of the month, I do a group portfolio and personal portfolio video. So I like just to separate those two videos by at least 2 weeks. Interesting times in the markets right now. I'm not sure if the market's going to go up or down from here. So a lot of uncertainty in the markets, and you can definitely see that when you look at the charts, which I'll show you over the next few slides. So whenever the market's like this, I never go straight to cash or all to cash, never go fully invested. I think those sort of things, you are increasing your risk no matter what, unless we're in a really good, strong bull market. That's when you want to be all invested. Or if you're in a really strong bear market, that's when you might be thinking of going highly to cash. I wouldn't go all to cash because there are a lot of companies out there whose share price do go up when there is a bad market. And I am finding those companies right now. And those are the companies I am trying to add to my portfolio. Those companies whose share price are in an uptrend and there is a lot of positive sentiment behind those companies. Quite a few companies I have found over the last few weeks who fit that bill. So these sort of situations, in these sort of times, the buy and hold strategy that we are taught to use doesn't really work all that well. So you do have to change. This is just my opinion. You do have to subtly change your investing strategies during these uncertain times. Before we have a look at the most recent updated XJO, I just want to go back 1 month ago to see where we were when I did the last video. And on the February 18, the XJO was at 7,221.7. And it's really interesting to see what's happened in the past month, because even though there's been a lot of volatility, it does seem like we should be up a fair bit, but that's all about recency bias because of what's happened in the past few weeks. So even though it does feel like we should be up a fair bit, if you look at the updated XJO, which I'll just show you now, we're only up 1% from 7,221.7 to 7,294.4. Now, this is up until the end of trading to March the 18th. It does not include trading for March 21st and March the 22nd. I am recording this video just after trading has begun on March the 22nd. But so even though the last few weeks, we have seen a good rise in the XJO, the Australian markets, in fact, it's risen from less than 7,000 to 7,294.4. The first 2 weeks of last month, we actually did see the XJO fall a fair bit as well. And there is a really strong resistance level right on 7,300. And if we go back into February, the last time I did that video, we had seen the XJO really struggle to get above that resistance level. Twice, we saw it get above 7,300, then a lot of selling came in. And you can see that with individual candlesticks with a high or, the tail, a long tail to the upside. That means there's a lot of selling during those days. And the XJO really struggled to get above that level. And on the March 18, we did see the XJO reach 7,300 or just shy of 7,300. And then on March 21st, which I've not included here, the XJO went above 7,300 on seemingly good strength, but a lot of selling came in during the day. In fact, the XJO was down for the day. So again, that resistance level has held firm up until the end of trading on March 21st. But initially in March the 22nd, and I'm recording this video 1 hour after markets have opened, and the XJO was up about 1%. If we don't see selling during the rest of today, maybe the XJO will close above that resistance level. And that could be a bullish move for the XJO and the Australian markets. Now let's have a look at some of the American markets, starting with the NASDAQ. We'll also have a look at the S&P 500 and maybe the Russell 2000 as well. Now the NASDAQ daily is in a downtrend. It's been a downtrend for the last few months. We were in a nice uptrend ever since COVID-19, but we've seen the NASDAQ for a fair bit over the past about 4 or 5 months. The top in the NASDAQ was actually in August last year. We saw nearly a double top, but ever since that near double top, we have seen a fair bit of selling off or selling in the NASDAQ in these tech companies. Now, it fell all the way down to almost 13,000 around about when Russia invaded into Ukraine. And then we saw a rally. So that was sort of sell the rumor, buy into the fact. I don't absolutely agree with that sort of strategy, because even though the market doesn't like uncertainty, doesn't like risk, when another country invades into another country, the risk does not decrease. In fact, a lot of thinking was the invasion wouldn't last that long. Well, it's been about a month now, and Ukraine are doing a fairly good job at resisting Russia. And then after that relief rally, we saw the NASDAQ pull back towards 13,000, test 13,000, and we have seen another relief rally over the past 4 trading days. And the reason the NASDAQ has rallied in the last 4 trading days up until March the 18th was because the Fed raised interest rates. Again, sell the rumor, buy into the fact. Again, I'm not sure why they've done this, because interest rates rising is not good news for tech companies and not good news for equity companies either. So that support level at 13,000 is a fairly strong support level at this point in time. And the NASDAQ up until March 18 was right on a nice little resistance level, which is the previous high we saw just after the Russia invaded Ukraine. But we just look at the moving averages, they're both going down. The NASDAQ is below both moving averages. So at this point in time, the downtrend is still intact. It's a short-term downtrend. We don't know how long this has to play out. So at this point in time, I wouldn't be going completely into tech companies at this point in time. I have seen a couple of YouTube videos, a couple of experts who say now is the time to go all in on tech companies, just because of what we've seen over the past 4 trading days. I think that's being a little bit too premature. There still could be some downside at play, and the downtrend right now in the NASDAQ is still in play. It's still in a downtrend, the NASDAQ. So don't go too hard at buying companies because you think this little weakness in the market has come to a completion. Same thing can be said of the S&P 500, a really good support level at around 4160, and that was reached 3 times in about a 1 month period. And then we have seen the S&P 500 take off again because the Fed's raised interest rates. And right now, the S&P 500 to the end of closing on March 18, so not including trading on March 21st, S&P 500, NASDAQ were down for the day. And up until the end of trading on March 18th, the S&P 500 had just reached the 100-day moving average and had pulled past the 50-day moving average. And fun enough, there were quite a few commentators talking about how the S&P moved above the 50-day moving average and needs to remain above that for this to be a bullish move. So again, I think there is a little bit of resistance moving forward because of where the S&P has moved, because of this relief rally as well. And it wouldn't surprise to see a little bit more weakness in the S&P 500 over the next few weeks and maybe test that support level at 4160 again in that time period. Now onto one of my favorite indices, that's the Russell 2000, looking at the biggest 2000 companies in the United States. The reason I like this chart is simply because there was a support level at 21.25 or near that held firm for about a year. And then that support level was broken in January on fairly good strength. So that support level became resistance. And the Russell 2000 has struggled to go above that resistance level, but there's another support level at 1925. And the Russell 2000 has hit that support level on 3 occasions. On 2 occasions, it fell below that support level, and then a fair bit of buying came in. And right now, we're at another fairly weak resistance level at about just less than 2100. I wouldn't be surprised if that resistance level is overcome, but the Russell 2000 was down a little bit on March the 21st. So it looks like that resistance level, a fairly weak resistance level, has held firm at this point in time. So at this point in time, looks like Russell 2000 could be trying to trade range between that resistance level and that support level. And if we break that resistance level, that will be a bullish move. If we break the support level at 1925, that would be a bearish move. So again, I'm fairly neutral when it comes to Russell 2000. As we take a look at the XSO, which is the ASX small caps, I do like to look at this, and a really nice triple top back from September through to late December, early January at around about 3,600 or so. So that's a really natural resistance level, and that is a topping pattern as well. And then we saw that massive decrease in the XSO towards the end of January, fell to a support level, nice little relief rally, and then we fell back towards that support level, and then we've bounced off it again. So a nice little support level at around 31.25, and this still looks like the SSO is in a new downtrend. Maybe this is a short-term downtrend. So even though a little bit bearish about the XSO, just like I'm bearish about the XGO, probably even the NASDAQ, S&P 500, more neutral when it comes to the Russell 2000. I think there is more potential for downside in the future for all these indices, just because we're in this short-term downtrend. I need to see some strength before I become bullish in any of these indices in any of the equity markets. Now onto gold, and this is gold up until February the 18th. And the reason I was interested in gold at this point in time was because there was a nice resistance level just above where gold prices were, and it did look like gold prices were trying to break out at this point in time. So I was really bullish on gold on February 18th. I just thought it had to get above this resistance level, and if it got above that resistance level, that would be a really bullish move for gold. So let's have a look to see if gold actually did get above that resistance level and whether my bullish thesis was playing out. And yes, indeed, gold went right above that resistance level, which has now become support. That's what happens. Resistance becomes support whenever the price of the thing you're following moves above that level, and then support becomes resistance if the price falls below that level. And the reason why that is support is because the gold has tested it and has bounced off it. In fact, the gold fell through the support level for a brief period of time on one trading day about 1 week ago, and then we saw buying coming in. So that support level has held firm. I do like to see tests of support and resistance levels. And there is another resistance level at around or just above 2060, and that was the recent high we saw in August 2020. So if you just draw a line, straight line from that resistance level, you'll notice that recently gold prices tried to get above that resistance level and failed. It tested their old resistance. Well, it's not old resistance level. It's the old highs we saw back in August 2020, and then pulled back and tested support. So at this point in time, definite uptrend in gold. We've seen really good testing of support and resistance levels. If we saw gold go above that resistance level, 2060 on strength, that resistance then would become support. That would be a really bullish move right now. But it's really good that this support level at just below 2000 has remained strong, it's been tested, and that's a good indication that this uptrend in gold prices, there is some strength to it. Now onto iron ore, and iron ore's chart's an amazing chart, beautiful volatility in iron ore prices over the past year, I'll say maybe, about a year or so. We saw iron ore gets to prices well above 200, and then we saw the iron ore prices collapse. Share prices of a lot of iron ore producers fell off the cliff as well, but we have seen iron ore prices move into an uptrend. The funny thing is, with a lot of iron ore companies, some of those companies' share prices have not moved into an uptrend themselves. I think there is some opportunity in some of these iron ore producers because the market hasn't reacted to the companies in regards to their share price moving up, unlike what we're seeing with iron ore prices. And when some of these companies release their quarterly results, I think the market might be a little bit surprised. So I do think there is some opportunity out there. I'm talking like Phoenix, even Mineral Resources share price fell a fair bit because of their half-year results. So have a look at some iron ore producers, have a look at their charts, their share prices. And if we're not seeing the share prices moving up to corresponding with what we're seeing with iron ore prices, there could be some opportunities out there. Let's have a look at oil, and this is a beautiful upwards chart for anyone who's been owning oil. Maybe I wish I was an oil tycoon right now, because I would probably be swimming in my own oil. Well, maybe I wouldn't do that. I'll be swimming in my own cash because of the money that's would be flowing in because of high oil prices. It's really funny. I was listening to the Motley Fool podcast with Andrew Page and Scott Phillips. And Scott Phillips is absolutely certain that the amount of money you're paying at the Bowser will be significantly lower in 1 month time. I'm not sure if he knows that oil prices at the Bowser are a rolling average. So what they do is they use the past month or something like that as average oil prices. And there is a chance that oil prices actually in 1 month time will be significantly higher than they are now, because oil prices are still in an uptrend. We saw a significant increase in oil prices about 1 month ago. It rose from about 92 to a high of 128. And whenever you see that sort of rise, there will be a pullback. That's exactly what we saw. In fact, it pulled back to a nice support level, which is the 50-day moving average. And it's bounced off that 50-day moving average, and it started to go up again. I've seen some forecasts of oil getting up to $150, $175 a barrel. I'm not sure if I believe that. I sort of do actually agree with Scott Phillips, and he thinks oil, this is just cyclical, and eventually, because supply will start increasing as more of the shale producers in America, more oil companies see higher prices, so they start producing more and more oil. And as we see an increasing supply, and if the demand doesn't increase with supply, we're going to see supply demand forces come into play and oil prices will fall. The other thing to take into account as well, and I've mentioned this maybe once or twice, is that over the last 10 years, lots of mining companies around the world have not spent money exploring on infrastructure, on development, that sort of thing. They've just given the money back they've made in their mining back to the shareholders. And so lots of lack of money spent means there is a possibility that even if we do see some supply issues, there won't be enough supply coming online to meet those demand or supply issues. And that's why commodity prices might keep going up for an extended period of time until mining companies start to spend again. They're not spending enough money at this point in time. They just want to give the money back to the shareholders. So that's one little thing we have to take into account over the next 5 to 10 years, is just the lack of spending mining companies done over the past decade. Originally, I was going to release this video on March the 21st, but when I looked at this particular chart, I did see something really interesting. So over the past 40 years, we've seen the greatest bull market of all time. These are not my words. These are other people's words, that we've seen the greatest bull market of all time, a 40-year bull market when it comes to bonds. And you might be saying here, well, but this chart is going the wrong way for a bull market. It's going from the top left to the bottom right. But this is yield. So this is a US 10-year government bond yields. And don't forget that yields and bond prices are inversely related. So if bond yields are going down like this, that means bond prices are going up. I explained that in the last video, but it did take me a little bit of time to make sense of it. But it's absolutely, or does absolutely make sense, that if bond yields are falling, bond prices should go up. And if bond yields start going up, bond prices should going down. That's why this is the greatest bull market of all time, because bond yields have been consistently falling over the past 40 years. And whenever we've seen an increase in bond yields over a short period of time, we've seen problems in the economy, problems in the equity market. And this has happened quite a few times over the past 25 years. The first time I saw this was back in 1994. We actually did see bond yields rally a little bit. And during that same rally in bond yields, we saw a significant, well, maybe not significant, but we did see the NASDAQ pull back 16%. And then from 1995 to 2000, what happened in that period of time? We saw a massive NASDAQ rally. We saw a really good bull run in the NASDAQ. And during that period of time, you can see bond yields fell quite a lot in that period of time. And then the tech bubble burst. And right at the top of the tech bubble burst is when we saw the top of the government bonds yields. In fact, it hit this is the 50-week and the 100-week moving average. So the top one is the 100-week moving average. And when the bond yields hit the 100-week moving average, that's when we saw the tech bubble burst and bond yields started to fall. Again, during the GFC, that's another time we saw bond yields hit the 100-week moving average. And there was a little bit of displacement between the top of the bond yields and the start of the GFC equity market slide, but they were almost correlated, not quite. And then over the next year or so, we saw a significant decrease in bond yields. And then what happened between 2009, the bottom of the equity markets, and around 2018 or so, we saw bond yields falling. And then towards the end of 2018, I think it was towards the middle of 2018, end of 2018, we started to see bond yields rise again. And in fact, the bond yields went above the 100-week moving average for about a few months anyway. And during that period of time, the NASDAQ corrected 17% because everyone was concerned about rising interest rates. And then what happened after the end of 2018? Well, we saw a significant decrease in government bond yields. They dropped off a cliff almost. And what happened with equity markets during that time? We saw a massive bull run on the NASDAQ. So again, a good correlation between the equity markets, particularly the NASDAQ, and bond yields. But over the past year or so, we've started to see bond yields rise again. And right now, the US 10-year government bond yields are right above the 100-week moving average. And every single time in the past 25 years, whenever we've seen the 10-year US government bond yields get above the 100-week moving average, something serious happens. As we ever see a tech bubble burst, we see a GFC or a major correction in the market. So even though we've seen the market correct, there still could be more to go. The other thing is, there's not much more room for bond yields to fall from here. Can it go to -2%, -3%? I'm not sure that is healthy for the economies at large. So I think this 40-year bull market is coming to an end. And that probably might not be good news for equity markets. And that's why I think if we've seen significant, or you've seen significant returns in your portfolio over the past 40 years, if you've been an equity investor. And I think those good times are coming to an end. And the expected returns you might have over the next 10, 20 years is going to be significantly lower than what you've experienced in the past 20 years. And that's all because of bond yields. And more than likely, we're going to see bond yields rising from here. Now, in saying that, I could be completely wrong, because when you look at the bond ETF, TLT, and this is bond prices, again, this has been going up. This goes back to 2002. This has been going up. So bond prices have been going up over the past 19 or 20 years because bond yields have been going down. And this is the proof that bond prices, bond yields are inversely related. But the interesting thing is, when you look at the bond ETF, TLT, it's right on a support level right now. And the last 3 times we've seen the bond ETF, the TLT, hit the support level, which is again the 100-week moving average, or this could be a month average, we've seen the bond prices start to go up, which means the bond yields start to go down. And that sort of corresponds to what we saw in the last graph, that the bond yields are now above 100-week moving or 100-month moving average. And every single time we see the bond yields above the 100-week moving average, we see something happen with the economy, equity markets, and then interest rates start going lower. The Fed, the reserve banks around the world, start lowering interest rates. Will they do that again? Will we see lowering interest rates? Well, the central banks around the world are starting to raise interest rates because of inflation. And that's why we're in interesting times. The reason we're starting to see interest rates rise is because of inflation. They want to keep inflation under control. We have not had inflation problems over the past 40 years. So this is something that is, central banks around the world have to deal with. And if they can't control inflation by raising interest rates by a few percentage points, they're going to have to keep raising interest rates. And that's where we might get into some significant problems in the future. The other problems are we're starting to see economies slow down. And you don't raise interest rates when economies are slowing down. You raise interest rates when economies are too heated. And that's the whole reason you raise interest rates, to take the fire out of the economy. So there is a possibility we're seeing interest rates rise at exactly the wrong time in the economic cycle. And this actually could lead to stagflation. And that is the worst thing we can experience. Stagflation is by far the worst thing, and by far the one thing we don't want to see, because in a stagflation environment, we don't see our wages rise, but inflation rises, and we see real wages in decrease, that sort of thing. We don't want a period of stagflation. That would be the worst news for the economies, for governments around the world, for every single person on this planet, except the really, really rich. Now let's have a look at the Australian 10-year government bonds. So this is bond yields, I haven't put that here, and definitely has moved into an uptrend. In fact, this goes back to 2008. So this is a weekly chart. And if you look at any potential uptrend in the government yields during this period of time, so that's a 13-year period, there is no sign of any uptrend up until right now. And in fact, if I was looking at a chart of a company and this was a stock price, I would be very bullish about that company just by looking at this particular chart. And the yield right now is almost at the same point it was during 2017, 2018. You can see during those 2 years, the bond yields were going sideways. So there was not much volatility there. And that is sort of a natural resistance level. And if we go above that period, or if bond yields go above that percentage, which was around about between 3% and 2.4%, if we get above 3%, that would be a fairly bullish move when it comes to bond yields. So again, it does look like bond yields are going up. Interest rates are going up. This is an expectation right now. One of my favorite 10-year government bond charts is Japan. This has been, or their government bonds, 10-year government bonds, have been in a well-defined downtrend for the longest time. And that downtrend has come to a completion. And it looks like finally the Japanese 10-year government bonds are starting to go up. And right now they're at a 6-year high. Last time we saw, or Japan saw their 10-year government bonds this high was actually way back towards the end of 2015, start of 2016. That's all I have for this State of the Markets video, March the 22nd. If you have any insights, if you totally disagree with me, I'd love to hear your opinion, your counterpoints. I could be completely mistaken. I can be wrong, and wrong often. So I'd love to hear counterpoints. I love to hear differing opinions, because that's how we learn. And that's probably the best way to learn, is if we hear someone else's opinion, which can be different than ours, and we're open-minded about that. A lot of people out there in the world are so closed-minded. When they hear a different opinion, they just ignore it. They push it aside because their opinions are right and nothing can change their mind. So you want to be open-minded. You want to hear differing opinions. And that's the best way we can grow as not only people, but also as investors. So I'd love to hear your opinion. Anyway, so leave it in the comment section of this video. The last thing I should mention is I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a great day. Bye.